Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Imagine a company posting over $500 million in raw operational earnings in just a single quarter.
Right, a massive number.
Yeah. But here is the catch.
Yeah.
More than half of that money didn't actually come from selling more product or, discovering a new oil well or something.
No, it definitely didn't.
It was effectively handed to them through a government regulatory exemption, which is just, it's the wild high-stakes reality of the modern energy sector that we're looking at today.
It really is. I mean, it completely shatters that old illusion that massive energy companies just, pump oil out of the ground, refine it, and then just sit back and count their cash.
Exactly.
The modern energy landscape is this sprawling, highly engineered ecosystem, and a single policy shift in Washington can literally swing a quarterly balance sheet by hundreds of millions of dollars almost overnight.
So welcome to the deep dive. Our mission today is to unpack this incredibly complex, rapidly evolving landscape, and we're going to do it through the lens of one specific giant, which is HF Sinclair Corporation.
Right, trading under the ticker symbol DINO.
Yes, DINO. And to do this, we are working off a stack of fresh sources today. We are diving into a comprehensive new research report from Compasscope, which is dated today, actually, April 13th, 2026.
Hot off the presses.
Literally. And we are pairing that analysis directly with the raw transcript from HF Sinclair's Q4 2025 earnings call, which was back on February 18th.
And blending that macro-level strategic analysis from the Compasscope report with the actual ground-level commentary from the people running the company, it just gives us an incredibly clear picture of the machinery at work here.
Yeah, and we've framed this exploration specifically for you, the listener, because if you love understanding the actual mechanics of a massive business,
Right.
Evaluating market positioning and uncovering hidden value without needing a glossary of Wall Street jargon to decipher the conversation, well, you are in the right place.
Absolutely.
We're going to break down DINO's operating lines, measure them against their fiercest competitors, analyze their growth strategy, and look at the very real execution risks hanging over their heads right now.
And then distill all of that down into the key trends you actually need to watch.
Right. So to evaluate where a complex organization like this is heading, you first have to understand the fundamental physics of what they actually do every single day.
Yeah, to understand where they're going, you need to know what they are.
Exactly. So let's start there with the company's business lines. When I read through the Compasscope report, HF Sinclair doesn't look like a traditional linear manufacturer at all.
Not really. Yeah.
It looks more like a self-contained, vertically integrated ecosystem. So I want to understand how a drop of oil actually moves through this massive machine.
That's the best way to look at it, really, just following a drop of crude oil.
Okay, walk me through it.
So let's say DINO buys a barrel of cheap, heavy crude oil from Canada. That barrel first enters their midstream and logistics division.
Which is like the transportation arm, right?
Yeah, right. These are the literal arteries of the company, the pipelines, the terminals, the storage tanks. And they operate under a sort of toll booth model. So they transport that crude to the core of the business, which is the refining and fuels division.
And they have quite a few refineries, don't they?
Yeah, DINO operates 7 refineries. They primarily dominate the middle of the country, so the mid-continent, the Rockies, the Southwest. And they do have one outpost on the West Coast at Puget Sound.
Okay, wow.
And together, all of those are churning out around 678,000 barrels per day.
So they take that raw crude, they refine it into gasoline or diesel, and then what? It goes straight to the consumer.
Basically, yes, it goes to their marketing and retail division. This is the consumer-facing arm, the Sinclair brand with the green dinosaur logo you see on the highway.
Oh, right, the dinosaur.
Yeah, and they actually just announced a new joint venture called Green Trail Fuels LLC with UPOP Holdings to expand that retail footprint. But here is the brilliant part of having both the refinery and the gas station. It actually solves a massive regulatory headache called RINs.
Okay, yes. I saw RINs mentioned heavily in the earnings call. And for those of us who aren't trading energy compliance credits on the weekend, what actually is a RIN? And how does owning a gas station solve that problem?
So RIN stands for Renewable Identification Number. Under federal law, refineries are basically obligated to blend a certain amount of renewable fuels like ethanol into the nation's fuel supply.
Okay.
If a refinery doesn't have the actual infrastructure to do that blending themselves, they are legally required to go into the open market and purchase these RIN credits to prove that they complied.
Oh, I see.
And the price of RINs can swing wildly. I mean, it creates this massive, totally unpredictable cost for pure play refineries.
Which means your profit margins are essentially just at the mercy of this artificial credit market that you can't control.
Exactly. But DINO is insulated from that. Because they have their own branded retail network, they do the actual blending at their own distribution terminals before the fuel ever hits the gas pump.
So they just do it themselves.
Right. By doing the blending themselves, they generate their own internal RINs. The marketing division effectively prints the compliance credits that the refining division needs.
Wow.
Yeah, it completely shields the entire company from that market volatility.
That makes perfect sense. It's like a structural synergy built right in.
Yeah.
And they also have two other divisions layered on top of this, right? The renewables arm and the lubricants business.
Yes, exactly. The renewables division features about 380 million gallons per year of renewable diesel capacity. They're taking feedstocks like soybean oil or animal fats and chemically converting them into diesel.
Right.
And then finally, you have the lubricants and specialties division, which produces base oils and heavy-duty industrial lubricants. And they actually just absorbed a new acquisition there called Industrial Oils Unlimited to expand their product offerings even more.
Okay, so I'm looking at this whole structure, right? You've got the pipelines feeding the refineries feeding the gas stations shielding them from regulatory costs.
It's all connected.
Yeah, it looks like an incredibly efficient, defensible loop, which kind of brings me to a major contradiction that I noticed when I was looking at their competitors in the report.
Okay, what's that?
Well, if DINO operates this highly synergistic ecosystem, and they're positioned right near some of the cheapest inland crude oil sources in North America, why are their operating expenses so high? I mean, the report notes they are spending well over their targets. Are they basically tripping over their own complexity?
You've zeroed in on the exact leak in their moat right there. Let's talk about the operational expense, or OPEX. In 2025, their operating expenses hit $7.67 per barrel.
Which is high.
Right, because their long-term stated management goal is $6.50 per barrel.
Wow, okay. Over $1 difference.
Yeah, and being over $1 off target might sound like pocket change to a normal person, but when you are processing 678,000 barrels a day,
That adds up fast.
it translates to hundreds of millions of dollars in lost profitability every year. They are definitely struggling with aging facilities and just the sheer friction of running such a diverse, widespread regional network.
So if they are lagging on sheer operational efficiency, how do they actually compete against the massive best-in-class players out there? Companies like Valero or Phillips 66.
Well, they compete by playing a completely different game.
How so?
The mega majors like Valero, they are built around these massive, highly efficient Gulf Coast refineries. They are basically global export machines. If margins dry up in the U.S., Valero can just put millions of gallons of diesel on a ship and sell it to Europe or Latin America.
Right, they have that global reach.
Exactly. DINO does not have that global optionality at all, and they definitely trail the mega majors in pure operating reliability.
So what is DINO's actual advantage then? Like, why would you hold the stock if they can't go toe-to-toe with Valero on efficiency or global reach?
The Compass Scope report identifies their advantage as and this is a quote, moderate but real competitive moat, and it's built on two main pillars.
Okay, what's the first one?
First is a highly conservative balance sheet. They carry only about 15% net debt to capital.
Which is pretty low.
It's very low. And in a cyclical industry like energy, which goes through these vicious boom and bust periods all the time, a 15% debt load means you survive the busts without really breaking a sweat.
Right, you're not scrambling to pay the bank.
Exactly. Whereas smaller, highly leveraged regional peers, companies like PBF Energy or Par Pacific, they might really struggle to make their debt payments when margins collapse.
I see. So they're vastly more defensible than the smaller players. So what is the second pillar of their moat then?
It's the Nelson Complexity Index of their legacy refineries. This is a crucial metric in this space. Compass Scope notes their refineries have an average complexity rating of around 12.1.
Okay, I always see that term in energy reports. Can you break down what a 12.1 complexity rating actually means in practice?
Sure. Think of a refinery, like a kitchen. A low complexity refinery, say it has a rating of 4 or 5, is kind of like a basic diner. It requires premium, expensive ingredients like light sweet crude oil to easily boil it down into gasoline.
Okay, makes sense.
But a refinery with a 12.1 complexity rating, that is like a master chef with a state-of-the-art kitchen, it utilizes deep conversion units like cokers and
Right,
hydrocrackers.
the heavy machinery.
Exactly. And this means it can buy the absolute cheapest, lowest quality, heaviest, sourest crude oil on the market. We're talking stuff that is as thick as molasses and just full of sulfur. And they can take that and chemically break it down into high-value premium diesel and gasoline.
Oh, wow. So they buy the heavily discounted raw materials that almost no one else can process, but then they sell the finished product at the exact same market price as everyone else.
That is the core of their margin capture right there. They dominate the regional markets in the Midwest and the Rockies by leveraging that exact complexity.
So since they are playing this regional dominance game rather than the global export game, that has to dictate their growth strategy, right? I mean, if you are Valero, you grow by building a multi-billion-dollar export terminal. How does DINO grow? Because looking at the capital allocation in the report, they certainly aren't building any new mega refineries.
Well, building a new refinery in the United States right now is essentially impossible anyway, due to environmental regulations and the sheer capital costs.
True.
So DINO's strategy is entirely focused on highly targeted optimization. They are looking at their existing machinery and finding very specific, high-return ways to just squeeze more cash out of it.
And the Compasscope report highlights one project that perfectly illustrates this, I think. It's called the El Dorado Value Furnace Project. But I need you to walk me through the math here, because the return on investment looks almost too good to be true.
Yeah, the math is fascinating on this one, and it shows you exactly how value is created in refining. So the El Dorado Value Furnace has a total capital cost of about $55 million. And they already spent $37 million of that in 2025. What this furnace does is physically unbottleneck a section of the refinery, allowing them to process an additional 10,000 barrels per day of that heavy, highly profitable crude we just talked about.
So they spend $55 million basically once. What is the actual financial payoff for that?
The expected uplift to their EBITDA, which is effectively a proxy for raw cash earnings, is $25 to $7 million every single year.
Wow. Wait, really?
Yes. You spend $55 million to permanently increase your annual earning power by $30 million. That is roughly a 2-year payback period. It is just an incredibly capital-efficient way to grow.
That is wild. And it looks like they are applying this sort of optimization philosophy across all their divisions, right? Not just the refining side.
They absolutely are. In retail and marketing, they are slowly growing their branded footprint by about 10% annually.
And that Green Trail Fuels joint venture we discussed earlier ties into that.
Right. That JV adds 30-plus strategic retail sites in Colorado and New Mexico, so it expands their regional footprint without requiring a massive upfront capital buyout.
Smart.
And in renewables, they have already spent the heavy capital to build the 380 million gallon platform. Now they are transitioning into an optimization phase there too, targeting 20% to 30% internal rates of return simply by running the plants more reliably and negotiating better prices for feedstocks like soybean oil.
And there is also a major midstream project they are evaluating, right? The report mentions a potential final investment decision by mid-2026. For a multi-phase westward expansion of their refined products pipeline. What is the strategic logic behind pushing a pipeline out west?
It really comes down to geographic arbitrage. Fuel prices on the West Coast, specifically in places like Utah, Nevada, and the Pacific Northwest, are structurally higher than in the Midwest or the Gulf Coast due to a general lack of refining capacity out there.
Supply and demand.
Exactly. By expanding their pipeline westward, DINO is basically building a toll bridge that allows them to push their cheaply refined inland products into those premium-priced Western markets.
Okay, so the overarching strategy is clear. It's low-risk optimization, unbottlenecking existing assets, and capturing regional price differences.
Yeah.
It all seems highly achievable, especially given their low debt. But here is the critical pivot.
Right.
A strategy built on meticulous operational optimization requires absolutely flawless execution. You can't squeeze extra margin out of a complex system if the system keeps breaking down. And looking at their track record recently, I see a lot of execution risk.
The integration footprint is incredibly dense for them right now, and the friction is definitely showing.
Because they are simultaneously juggling the integration of the legacy Sinclair assets, the Puget Sound refinery they recently acquired, and the new lubricants businesses all at once.
Yeah, that's a lot of moving parts.
Right. And the Compasscope report points out these unplanned outages, like a recent event at their Artesia facility. Plus, they're facing a grueling turnaround schedule where multiple plants have to go offline for heavy maintenance.
Exactly.
But honestly, the operational hiccups feel kind of secondary to the massive governance issue hanging over the company. I mean, we really need to discuss the leadership vacuum.
The governance overhang is arguably the biggest immediate risk to the stock right now.
Yeah, because during the Q4 earnings call, the company announced that CEO Tim Go has taken a voluntary leave of absence. And at the exact same time, the audit committee of the board of directors is conducting an active review of the company's disclosure processes.
Which is never what you want to hear.
No, that is a terrifying sentence for an investor to read.
It really is. And it's the primary reason the Compascope report assigns DINO a very high uncertainty rating. I mean, think about it. Attempting a massive multi-front cost reduction agenda, trying to get your operating expenses down from $7.67 to $6.50, that requires a management team that is completely relentlessly focused on plant reliability and contractor efficiency.
Right, you need all hands on deck.
And having an active audit review and a missing CEO creates severe execution risk. It fractures the attention of the executive suite right when they can least afford a distraction.
So with these severe risks hanging over them, the operational friction, the high OpEx, the governance cloud, how is the business actually performing in reality? This brings us to the recent business updates and that Q4 2025 earnings call from February 18th.
Right.
And I have to admit, I was completely baffled by the numbers here. They admitted they had a rough fourth quarter operationally. They had the Puget Sound maintenance turnaround, the Artesia outage, and they noted a late quarter drop in fuel margins. Yet somehow, they posted an adjusted EBITDA of $564 million for the quarter.
It seems like magic math.
Exactly. How does a company stumble operationally but still post $500 million in earnings?
The math works entirely because of an external regulatory windfall. To understand this objectively, without taking any stance on the politics or the policies themselves, we just have to look at the EPA's small refinery exemptions, or SREs.
Wait, this goes back to those RIN compliance credits we talked about earlier, doesn't it?
Precisely. The mechanism works like this. The EPA has the authority to grant exemptions to certain smaller refineries if proving compliance with the national renewable blending mandates would cause them disproportionate economic hardship.
Okay, so a bailout of sorts.
Essentially, the government recognizes that forcing a smaller regional facility to buy millions of dollars in expensive open market credits might bankrupt the facility or cause local fuel shortages. In the fourth quarter, HF Sinclair was granted these exemptions for several of their eligible facilities.
And the financial impact of having those obligations just wiped away was staggering, right?
Unbelievable, really. The exemptions provided a $313 million boost to their adjusted refinery gross margins in Q4 alone.
Wow.
Yeah, it generated nearly $300 million in raw cash flow. So more than half of their entire adjusted EBITDA for the quarter came from the stroke of a regulatory pen, bridging the gap between their operational hiccups and their strong bottom line.
That is incredible.
Yeah.
So what about the leadership uncertainty on that earnings call? How did the analysts react, and how did management address the elephant in the room regarding the audit review and the CEO's leave of absence?
Well, acting CEO Franklin Myers addressed it immediately in his opening remarks, but he kept it strictly bounded. He explicitly reassured investors that the audit committee's review is entirely focused on disclosure processes.
Meaning what exactly?
He stressed that the board is completely comfortable with the actual financial statements and the numbers released, and they fully expect to file their 10K annual report on time.
Ah, so he was trying to put a firewall between process and actual cash in the bank.
Yes, exactly. He essentially stated that the money is there, the math is correct, but they're just reviewing how things were communicated. And he actually refused to answer any analyst questions regarding the nature of the CEO's leave or the specifics of the audit, viewing the call purely as a forward-looking operational update.
Well, speaking of forward-looking, management sounded incredibly bullish about the trends heading into 2026.
Yeah.
What are the macroeconomic tailwinds they are seeing that give them that kind of confidence?
Well, management sees global fuel supply continuing to tighten. Demand for diesel and jet fuel remains robust, and critically, there is no massive wave of new refining capacity coming online globally to flood the market and crush margins.
Right.
But there was also a very specific geopolitical ripple effect mentioned on the call that benefits DINO perfectly.
Right, the situation regarding Venezuela. Can you explain the mechanics of how geopolitical news in South America actually translates to profits for a refinery in the American Midwest?
It goes right back to that 12.1 complexity rating we discussed. When geopolitical news broke regarding shifts in Venezuelan oil output, it created a shock in the crude oil market. And that shock essentially widened heavy crude oil differentials by $1 to $1.50 per barrel.
Meaning the heavy sour crude oil got cheaper compared to the standard light sweet crude.
Exactly. And for a company like DINO, which has the complex machinery to process up to 100,000 barrels a day of that discounted heavy crude, that widening differential directly lowers their raw material costs.
While the price of the gasoline they sell remains stable.
Exactly. It drops straight to their bottom line.
They also noted that renewable diesel margins are finally showing constructive improvement after a pretty rough period. They mentioned something called BOOHE spreads. What is a BOOHE spread, and why does it dictate their renewable profitability?
So BOOHE stands for bean oil minus heating oil. It is the fundamental equation for renewable diesel economics. Bean oil, or soybean oil, is the primary raw ingredient they buy. Heating oil represents the price of the finished traditional fossil fuel they are competing against.
Okay, I'm with you.
When soybean oil prices are high and heating oil prices are low, which is a wide BOOHE spread, it is incredibly unprofitable to make renewable diesel. The cost of your ingredients is higher than the value of your product.
But those spreads are narrowing now.
Yes. Soybean oil costs have stabilized, and the value of the environmental credits associated with renewable diesel D4 RINs are moving in a direction that makes running those renewable plants highly profitable again. It's transitioning the division from a break-even state back into a real cash generator.
We've covered a massive amount of ground here today. We've seen the foundational ecosystem of the company, their regional optimization strategy, the severe execution and governance risks, and the highly nuanced Q4 numbers driven by regulatory windfalls.
It's a lot to digest.
It is. So let's distill this entire deep dive into the ultimate watch list. What are the absolute key things you need to be monitoring to see if DINO's strategy is actually winning? I'll start with number one, the governance resolution. You have to watch for the final findings of the audit committee regarding these disclosure processes. And you really have to see who ultimately takes the permanent helm of the company as CEO.
Right, because until that is resolved, it is a severe overhang on the stock and a massive distraction for management. And I'd say number two on the watch list must be their cost targets. Can they actually hit and sustain that $6.50 per barrel operating cost target? They made some progress, taking $87 million out of their costs in 2025, but aging plants and the friction of integrating their newly acquired assets could easily cause those costs to bloat again.
And the margin of error in refining is incredibly thin.
Very thin.
Okay, number three, the Midstream FID. Keep your eyes peeled for mid-2026. Do they pull the trigger and make a final investment decision on that westward pipeline expansion? If they commit the capital, it basically proves they have the cash flow confidence and the operational bandwidth to execute on that geographic arbitrage, forcing their inland products into the premium-priced West Coast markets.
And finally, number four, policy swings. As an impartial observer of the energy markets, you must monitor the regulatory environment.
Oh, absolutely.
Watch what happens in PADDV, which is the West Coast region, where states like California and Washington are actively debating new refinery taxes, profit caps, and low-carbon fuel standard modifications. And simultaneously, keep a close watch on the EPA's handling of the renewable fuel standard and those small refinery exemptions. As we saw with the $300 million Q4 windfall, a single policy decision can radically alter this company's valuation overnight.
It really is incredible how tethered this heavy industrial manufacturing business is to the stroke of a legislative pen. Which brings me to a final thought experiment I want to leave you with as you evaluate not just HF Sinclair, but the entire energy transition as a whole.
Okay, let's hear it.
BO is aggressively optimizing a 380 million gallon renewable diesel platform. The stated goal of investments like this across the industry is to future-proof the business, right? To offset the long-term secular decline in traditional fossil fuel demand.
Right, that's the narrative.
But if the economic viability of your renewable diesel relies so heavily on government tax credits, volatile low-carbon fuel standard markets, and shifting EPA RIN policies, is a company like DINO actually escaping the volatility of traditional crude oil? Or are they simply trading unpredictable geopolitical commodity risk for equally unpredictable domestic policy risk?
It is a fascinating paradigm shift to consider. You are effectively trading the physical risks of global supply chains for the theoretical risks of legislative sessions.
Yeah, just something for you to chew on as you watch the engine of this energy empire continue to evolve. Thank you so much for joining us on this deep dive today. Stay curious, keep looking under the hood, and we will catch you on the next one.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, Find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on compasscope.com.